Hello, and welcome to this week's edition of Checks and Balances TV. Today's program is entitled, The Bull Market Turns 3. Is it time to get in or get out? So let's see how today's news may impact your financial future. Happy third birthday to the bull market. On March 9th, the stock market celebrated its 3-year anniversary of a continued bull run, rising more than 100% since the markets halted its deep decline in 2009. Renewed confidence in the stock market has resulted in a few milestones being reached so far in 2012, including the Dow Jones reaching 13,000 points for the first time in nearly 4 years. But how long will the good times last on Wall Street? And more importantly, is it time for you to get in or get out? Okay, so what's really going on here? Let's check the facts using our checks and balances process. What's being called the baby bull that nobody believed in has now turned 3, growing up in the shadows of one of the worst financial crises since the Great Depression. On March 9, 2009, the S&P 500 closed at just 676 points, tumbling from an all-time high of 1,565 points in October of 2007. Today, it's more than doubled since its low in March of 2009 and gained all but 12% of the losses suffered from the last market downturn. And many financial analysts believe this current bull market is going to continue. The S&P is currently trading at its highest level since June 2008, and the Nasdaq recently closed above 3,000 points for the first time since 2000. The markets have already topped the expectations of most Wall Street strategists, and the fear trading is reportedly over. Fear trading refers to the buying and selling of investments like bonds and gold, both of which are currently trading at much lower levels today. Most investors buy these investments when they're trying to avoid risk and are looking for safety. Since the markets are believed to be leading economic indicators, many investors have a renewed confidence in the stock market. They're prepared to take this bull market by the horns and profit from its potential upswings it could continue to produce. Now, a bull market is generally described as a time when the market trends upward for a period of time and investors are optimistic that it will continue. So they purchase more stocks and commodities. Higher demand leads to higher stock prices and typically greater economic growth. An increase in perceived wealth will cause people to spend more money on goods, resulting in an improved economy. A bear market is the exact opposite, a declining stock market which most often causes investors to sell their stocks and act more cautious or bearish, and the economy tends to shrink. A bear market occurs when a major stock index suffers a 20% decline or more. Many other analysts and economists believe that the current bull market is coming to an end, and the bearish times are quickly approaching. Okay, so now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. With all of the positive economic news recently, why would some economists believe this is the beginning of the end? After hitting a 12-year low 3 years ago, stocks have begun to rebound, thanks to a stimulus-induced cash infusion. Some investors, however, are filled with new worries that could put the skids on the current bull market. Topping the list of new concerns is rising gas prices, which could have a domino effect on the rest of the economy. Americans who have to spend more of their hard-earned money at the pump will have less to spend elsewhere to keep the economy going strong. Another growing concern is our country's national debt. Our government still needs to get spending under control, and the federal deficit needs to be reduced significantly. And when you add in inflation and the fear of higher interest rates into the mix, you have many Americans and some economists who feel the current bull market will come to an abrupt end soon. And if we do fall into a bear market, it's important to know that investors have lost an average of 39.5% during previous bear markets, going all the way back to 1929, including a 53% decline in the most recent one in 2008 and 2009. Considering that the stock market has averaged a 7% return for the past 65 years, a 100% gain in the past 3 years is a very big deal. A study conducted by the National Association of Active Investment Managers found that from 1987 through 2011, the average annual market return was 6.81%. That's pretty good news. However, if you missed just 10 of the market's best days during that time period, your average annual return was only 3.67%. And if you missed 20, it was just 1.65%. And if you happened to miss 40 of the market's best days during that time, your return was a negative 1.62%. Another study found that if you had invested $1,000 in the Dow Jones way back in 1928, the year before the start of the Great Depression, and missed the 30 best months through the end of 2011, you would end up with just $915 83 years later. However, if you missed the 30 worst months since 1928, you would have more than $7 million from the same initial investment. Okay, so what's the bottom line here? Today, investors welcome any sense of economic stability. However, our country's ongoing issues with housing, unemployment, the federal debt, and high gas prices make the overall environment anything but stable. The market may be riding the waves of positive economic news lately, but there is a lot of buying and hoping going on, which is contributing to the continuation of the bull market rally. Investors are ready for good news, and many are taking a gamble by betting on the potential upside of the market. The Fed's promise to keep short-term interest rates at 0% through the end of 2014 will likely continue to give stocks a boost. Although your decision regarding whether or not you should get in or out of the market really depends on your own risk tolerance. No one has a crystal ball, of course. So if you want to ride the ups and downs of the market, make sure you're only doing so with the money you can afford to lose. Another rule of thumb to follow is if the market or the money you have in the market keeps you up at night, then chances are you shouldn't have any of your money invested in the stock market. And now for Matt's weekly financial tip, tool, or technique. Many investors who are of the buy and hold mindset are hopeful they can get back what they lost and break even from the big market decline of 2009. Just 3 years later, the S&P 500 has still not fully rebounded to its pre-recession level. And unfortunately, many stockbrokers only offer this advice to their clients. Just hang in there. You know, the market always comes back. But how much longer will it take for the market to come back and for you to break even or get your money back? No one can really answer that question. But it's important to know that whatever percentage you lose in the market that you incur, you're going to have a bigger percentage of gain to recover your financial loss to even get back to even. Here's an example. If you were fortunate enough to have lost just 10% of your portfolio in 2008-2009, you would need to regain 11% to break even. That's not too bad. But if you lost 20% of your investment portfolio, you would need to regain 25% to then break even. But what if you lost 30% of your portfolio? You would have to regain 43% to break even. And if you lost 40% of your investments, you would need to regain or recover 67% of what you have left to get back to where you were or break even. And if you happen to have lost 50% of your investment portfolio, which is the average loss, by the way, experienced in the last bear market of 2008-2009, you would have to regain 100% of what you had left to break even. And this is what I affectionately refer to as double compounding in reverse. You see, if you lose 50% of any value over any period of time, you now have to try and gain back 100% of what you have left to get back to where you once were. And as you can imagine, this can take a very, very long time. Be sure to log on to our website and download our featured report, The Truth About Average Stock Market Returns. A free report that reveals the difference between average stock market returns and compounded rates of return. It's a big difference, so download this free report now. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Reddick from Checks and Balances TV. Until next time, dump debt, invest wisely, believe in yourself, and make it happen.